Welcome back to another episode of How to Make Money with Hard Money. We're here with some of the DKC boys on the sales side, and today is going to be a little bit more lax. We're just going to do some storytelling.
Yeah.
So we're going to just talk about a couple deals and give you guys some insights into what type of deals we fund and kind of the behind the scenes on how they're worked and underwritten and how we get to the closing table. So we'll chat about that, but I guess we wanted to start with just kind of framing up the market a little bit right now. I know we're producing a couple blogs to talk about this that you'll see coming out, but the big narrative right now is navigating tough exits, I think. And so from our perspective, we're seeing, if you're a real estate investor in today's market, and today it's July 2025 for a timestamp on that. But right now, navigating exits on your deals is the challenge that you're having. And decision making on that is coming down to personal scenarios. So I think it's different for everybody, depending on your credit, your liquidity, your asset that you have, your need and alternative use of funds. I think that all matters and ties in. So kind of navigating that on an individual basis is really important. But the way that we're seeing it is really three exits, and it's either, a sale, obviously, or a refinance to a long-term debt, or you're bridging the gap and you're using hard money to bridge. And sometimes that can bridge to a different market, or you're bridging to pull equity to, renovate, finish construction on a property to try to have a better sale price.
Yep.
And so as we know, supply is really heavy in Florida right now. It's very difficult to sell depending on where you are. Some markets are tougher than others, but it's a tough market. It's hard to sell. It's hard to refinance. And so hard money is certainly finding its niche in this market, which is really important. And we're seeing that.
Yeah.
So Caleb, I mean, we can go down the line here, but you'll hear that common theme between all these deals that people are navigating exits, right?
Yeah. Yeah. I think for today's market, understanding that that's a huge obstacle for our clients, the best thing and the proactive approach that we've taken is understanding what the exit looks like and what the options are available in the market, right? The volatility in the market is plain to see. And the funding options have tightened up. LTVs are tighter, qualifications are, more, they're looking into credit deeper, everything is becoming more difficult. So we're not traditional conventional lenders, but understanding how they can get out is pivotal to their success. I know we've been taking meetings with various lenders throughout the country to see what it's like for our clients to exit. What are the credit score qualifications? How many months liquidity is needed? Or what experience is like for them to be taken out? What are the current rates in today's market? These are some that we don't use on a daily basis so much, but we understand how to bridge the gap with hard money to get them shaped up for their exit so they can qualify at the end.
Yeah. Yeah, you mentioned credit. I know, I guess to talk about, I know Austin's had some recent experience with some credit repairs and what that could look like. So you can kind of dive into that. But, if you're on a 1-year bridge loan and you're going to either assess extending that bridge loan at, let's say 12% IO, interest only period, or you're thinking about selling the asset and you're not getting the offers that you want or what you think the asset could be worth if you, got a 1% Fed rate support, if it came down a little bit, that asset would be worth more in theory. So if you're not looking to sell because you need the cash or you need to get out of the deal and you do have strong cash flow from a rental or something and you want to DSCR refinance for a long term, you're kind of assessing the costs really.
Yeah.
And so that's why credit, I think, has been more important than ever for the exit. We don't have credit on our hard money loans, but to get out to a DSCR loan, you do. And the extensions for us, you have to pay your property tax, your insurance, an extension fee. You still have your monthly payment due. So the cost can be substantial. But Austin, tell us a little bit about like what kind of credit repairs have you seen out there?
Yeah, you bring up a good point. I think a lot of people know by now, like we don't have a minimum credit requirement, right? So when people come in with us, they might not have the best of credit, but if they want to refinance to a 30-year loan product, they have to have a minimum of 620 credit. So sometimes during that year, of course, everybody's plan is to improve their credit score, but it doesn't always happen that way, right? The year actually really does fly by, and I think people are noticing that more and more recently. So just a prime example, as of recent, we've been working to get one of our borrowers off our books. Just a proactive approach. We want to see that borrower in a better situation where they're paying principal and interest, right? And they have a lower interest rate. 555 credit score, got him connected with one of our contacts who does credit repair. They're giving him a 90-day window. They already went into his credit. They figured out exactly what they need to patch up to get him to a 620. And it was $350 up front and $350 in 30 days, right? So that's $700. It's not no money at all. But when you talk about what you just said, extending your loan so you're paying points, paying your property taxes, renewing your insurance, and making your monthly interest payment all within what, like a
10
to 20 day window.
Yeah,
that's a lot of money. So if we can help somebody increase their credit score so that they're in a better situation moving forward, personally, I feel like people remember that forever, and that's why they're going to come back to us the next time.
And don't get me wrong, there are certain scenarios where they just can't increase the credit. And if that happens and we're not going to extend the mortgage for whatever reason, maybe they're not in compliance, they don't have the cash to pay taxes and insurance, and they're left with one option, and that's sell.
Right.
And so again, it really comes down to the personal situation. Sometimes it's better to sell for a lower price, get your cash back, and stop the bleeding sometimes, or go to an alternative investment and get another deal at the new market rates.
Yeah, and I think also what's great about the approach that we've taken is we're having this hard upfront conversation from the start of the loan. So if at the end of the loan, we're like, hey, your credit didn't get fixed, or you were unable to sell the property at the price you want, you need a price reduction. But we could say, hey, remember, 8, 10, 12 months ago when we had this initial conversation. I know, Enrique, you do it with your clients all the time. I mean, what is that like for you, having, the tough conversation up front, but then have the ability to offer options in the back?
Yeah, I mean, it's definitely a challenge because in our industry, we're never in control of what the borrower does outside of the deal.
Right.
That's all we can do is, like Austin said, just kind of set them up for success, with our referral sources. But going back to David's point, exits are being very challenging for our borrowers. And I think one point that we didn't mention is also when they decide to refinance to a 30-year note, the servicing of the loan gets really difficult with high cost of insurance. Property taxes have not gone down yet, and at the same time, like you said, interest rates are high.
Right.
So the service of the notes, or to qualify for these 30-year programs, is getting very difficult.
Yeah.
So, even by fixing their credit, I would say that's like chapter 1 of exiting the loan.
And rents are softening or at least plateauing. So that kind of crunches that DSCR ratio.
Yeah, and Austin mentioned that the year goes by extremely fast, and I agree. And we're also, you're also seeing it on the extensions that when the client bought the property or came to us for the initial loan request, the property was worth X amount, and now when they're coming to you for the extension, you're seeing that the property didn't go up in value as much as the client wanted to, or the market's just not helping the exit.
Yeah.
So having this different, I think it's very important for investors nowadays to have more than one exit strategy for every deal.
Yeah,
absolutely.
In order to have success in this economy.
Yeah, the more options, the better, which is what you're saying too. And those options include liquidity, cash reserves, which is liquidity, and then having good credit. But borrowers that are over leveraged with poor credit and no reserves are finding themselves in difficult positions.
And I think that's what we're doing best to separate ourselves from others in this industry is, like Caleb said, setting up those meetings with potential sources to help our borrowers get out, and also just have that tough conversation up front, just dig in. Yep. And if the borrower, doesn't like what you have to say, it really is reality, right? So you're helping them out, and a lot of them thank you at the end of that conversation.
Yeah. Well, it's not all doom and gloom, right? I guess so. We're getting deals done, and we are seeing investors with a lot of success currently, still in the tough market. So we'll shift to a couple of those good stories right now on how we were able to help clients. But I guess last point is, I know you're messaging with somebody today. It's not all about high leverage, right? Just getting the highest leverage possible on every deal is not always the key to success.
It's actually dangerous.
It's actually dangerous. So, Austin, I know we'll start with you, and we'll bounce around here. But I know this past week we have 8 or 10 deals that we've closed in the last 2 weeks that we can chat about today.
Yeah. So in this example here, relatively unique. No two deals are the same in my personal opinion. This was an individual that's a licensed general contractor. He's built single families in the past. He bought a single family in St. Pete, ended up demoing the property, had a good relationship with a private lender who doesn't necessarily do new construction loans. So he was kind of just advancing funds as the guy moved along in the project. There wasn't any type of structured draw schedule. And he got to a point where he was dried in with this duplex in St. Pete. And the lender was basically just like, hey, we don't even do new construction loans. I think maybe at this point, you should go out and find somebody else. And he was a little bit shocked by that news, right? He was just going about his business,
Just stuck.
getting the job done, and he got stuck. He left a raving Google review about us, which is great. Kind of explained the whole story in his Google review. He was calling around. No one was interested in touching the deal. But for us, it's getting on the phone and just saying, what happened? Tell us a little bit more about what happened. He dug into the details, and we saw the ability to step in and help. I mean, there was certainly some equity there. We run our numbers, and we saw that the ARV was
Strong ARV on that one.
Very-
I was
yeah.
going to say it was probably
Very
a
strong.
higher initial release
Yeah.
at the beginning. It wasn't, the lowest initial release. It was certainly on the higher end, but the equity on the back end,
Yeah.
with the ability to perform and get there.
And I think just the comfort of closing that deal with him, laying out a draw schedule, knowing when he's actually going to get the money,
Yeah.
not having to send a text message like, hey, you think you can throw me some money? You could tell he was very, very comfortable, and, hopefully everything goes well and he comes back to us, and I think he will, but somewhat unique, right? Stuck in the middle of a project, calling around, thinking he's not going to get anybody to help him out. And 7 days later, we closed that deal.
Once you get that, once he gets that CO and gets the tenants in there too on the duplex, he's got the duplex behind that he can build, and I'm sure you'll be able to help him with the DSCR exit too.
Yeah.
Cool.
Yeah, but that has to be tough for a borrower. You think about the fact that you're uncertain about if you're going to get money or not. You're investing, I don't know if it was life savings or not, but he's investing a good amount of money into a project, but I may or may not get my draw. That's tough to go with someone. I mean, that's super stressful every day. I mean, I wanted to talk about a deal that I had that was super challenging.
Yeah.
It was something a little different. I like to say we're always logical lenders. We don't specialize in Georgia, but the deal was out of state. We predominantly are in the state of Florida. But it was a lady that had some code violations. She had a little bit of credit issues. It was around a 50 loan to value deal, not the largest deal in the world. Property was worth about 250 or so. But the biggest thing was she was Creole. She didn't speak English, so we had to do the entire deal through Google Translate via text message. She actually went to the closing table and no one spoke French or Creole at the closing table, and she got up and left. So I had to re-explain everything in French via text message, and she loved it. I explained how her code violations, would put us back. It was actually 3 code violations put us in 4th position.
Yeah.
We made exceptions, but we did a holdback to cover the cost of the code violations.
She had paid the code violations already, but they weren't showing as satisfied, right?
Because the state of Georgia, it's a 30-day lag.
Yep.
So no lender didn't want it. They're like, oh, we're going to be in 4th position. We won't do this loan.
Yep.
And her credit was a little low, so the capital markets really couldn't take it. But we could see past it, so we held enough money that even though she gave us the paid receipts, we held money regardless, and we were able to close, and we used Google Translate to do it, never actually having a phone call or doing any of that. Well, we
great.
did, but we realized we wouldn't be able to communicate. but it was
Did you learn any Creole? Or?
Honestly, I did not, but my
Won't
Goose-
put you on the spot to say it right now. But.
I don't want to say maybe some curse words, but that's about it.
Enrique, you had a couple this week that were pretty interesting.
Yeah, I could talk about one that relates to what you were saying at the beginning. The borrower was a little bit concerned about his exit strategy. He's a licensed contractor in the city of Tampa. He owned a property right off Hillsborough, for those that don't know, in the middle of Tampa, in the middle of the city, and he wanted to list it in the market. But he was concerned about his ARV. He didn't think he could get the most because the property needed some small cosmetic repairs. So he came to us. He approached us for a loan to pay off his current Harmony lender and have some extra funds to renovate, specifically the mother-in-law suite that was permitted.
Yeah.
I advised him that getting that renovated puts the property at market value, and he could get hopefully max return for the property.
Yeah, because it was like a converted garage essentially, right? But you're adding a couple hundred square feet on the property, so that really increased the ARV. I think we did a holdback on that one too, right?
Correct, because the borrower came to us with the open permit. So
he had started the
the project, and he came with us to us with a budget. So we pretty much set him up for success. Gave him a holdback with a draw schedule for him to complete the project successfully, and hopefully list the project in 90 days to 100 days. So
Nice, yeah, that was a really good one. Unique with the open permit, and we canceled the NOC and went on the NOC and as the lender. So I think that's going to be a good outcome for him too, really increasing the value.
Yeah, and the fact that also the borrower is doing everything permitted
Yeah.
You know, submitting plans, engineer letter, all that. That also made us feel a lot better
Yeah.
about, you know, the deal.
Yep. So I guess we have a quite interesting one that was on our books. It was actually an active foreclosure for us. We were it was cross collateralized across 3 different states. So we were in Georgia, South Carolina, and Florida. We were a second position lender in the Florida condo. The first position mortgage was almost 1.5 million, and the borrower had during the foreclosure went to pay off the first position lender, which increased the equity substantial. And the day before the auction in Georgia,
Yep.
we canceled the auction, or I should say, we extended the auction date another 30 days to allow that first position lender to be satisfied and prepare a satisfaction of mortgage, which opened up $1.5 million worth of equity on the deal. Right. So, you know, we negotiated a loan modification. It's really a new loan. We're going to release the South Carolina and the Georgia properties, allow him to refinance those assets and just become a first position mortgage on the Florida property. With that, you know, we can get 12 months prepaid interest. We can get all the defaulted fees and attorney fees that we had into the deal recouped and set him up. He has a very clear exit strategy to get out of that deal. He just needed time. And so he ran into some personal issues that kind of created that situation in the first place. But, you know, reinstating a defaulted loan and even allowing him to get a little bit of extra time was quite unique. I think we've seen several lenders not allow that, and, you know, sometimes we're the refinancier, but we were actually the default lender and the refinancier on this one. So that was pretty unique.
No, I thought that was. I mean, he had no shot unless it was us. There was no one saving that guy.
Yeah.
So but that's good.
24 hours before the auction.
Timeline was crazy.
Yeah.
Yes.
Speaking of timelines, I guess we got a couple fast ones that came at us. I mean, Caleb, you and Austin had 2 real fast ones.
Yeah.
I don't know who wants to start.
I actually, funny for context of this one, it was a client that I was trying to win their business. We've actually bumped heads in the past because, you know, as we always say, we give our opinion. You know, we're not, you know, the law about this, you know, we don't make all the rules, but in the end, we have a strong opinion about deals. And if we feel there are going to be large obstacles that they can't overcome, we're going to identify them and let them be known.
We're very clear about, like, this is not what your property's worth. This is just where we're comfortable lending against, right?
Exactly. So. And that's the whole thing. It's just our opinion and how we would like to lend the money. You know, people don't have to take it. And this client I've been dealing with for over 2 years. We could never find the right deal. We've denied several of the deals. We even got to the point where we wanted to do one, but it just couldn't come to fruition because they didn't want to meet us where we were comfortable.
I wouldn't even say denied. I would just say, you know, we were at a lower loan offering than they would like to take.
Exactly. And so they came to us again and said, hey, we have another opportunity, but it has to close. It was a Friday afternoon.
It was like 6 p.m., right?
6 p.m. And then also it's multifamily, which we know multifamily has been quite challenging to get funding. Anybody in the multifamily industry knows. So they came with a 12 unit in Tampa. On a Friday, had to close Monday, latest Tuesday morning. You know, we were able to obviously get the funding in order, but we looked at the cash flow. We felt comfortable with the asset. We felt comfortable with the loan to value. We made an offering to them, but got the call on Friday afternoon, got the docs and everything. Everyone worked over the weekend. By Monday, we were ready and clear to close, and we closed it Tuesday morning and met all the caveats. And the real issue for them was they had another purchase that they were dealing with where they didn't have enough cash.
Yeah.
So they needed to access the liquidity quickly, and we were able to do it for them.
Speed.
Yeah.
Love it.
Yeah.
I guess you have a speed story too.
Yeah. Yeah. Repeat client.
Actually slow but fast.
Started in, I think, April. And here we are in July. Slow but fast. Repeat client of mine. Very, very great guy to deal with. I know he listens to these podcasts, so
he'll know the story.
He'll know the story. But I mean, you came up in the multifamily space, right? So when a lot of people come to DKC Lending about multifamily deals, I always lean on y'all's experience in the multifamily space, which I think is great, and in new construction as well. Just learning along the way for me personally, being in the business now 2 years. But multifamily deal, I know I used the word unique in my last explanation, but definitely a unique asset. Multifamily, 8 units, definitely had some smaller units like 300 square feet, studios.
Like an odd configuration.
Yeah. And like you said, in our opinion, we felt as though he was overpaying for the property. So typically we would, do 70% of the purchase price. And just in this case, we didn't see the ability to do that. So I think he was expecting that we would, just based on prior deals, because we feel like he always buys right for the most part. And just in this case, relatively unique asset. didn't see that he should be paying what he was paying for the deal. So we came back with a term sheet where we felt comfortable. And he went and wanted to try to find another lender, which is totally fine with us, right? We don't hold grudges. And he came back this week and he liked where we were at. I think he was getting the same feedback from other people. It's nice to hear it from a couple others. And even the realtor or the owner. Was it the realtor?
There's the listing agent.
The listing agent. The listing agent was able to speak with David, who's a multifamily owner and operator, and wanted an explanation on how we got to our numbers. And then she was extremely, extremely grateful for your explanation. So we're here to provide our opinion and, in this case, expertise.
And I think, to be fair to the borrower, he, has a reason to pay the price he's paying. So it works for alternative reasons for him on that deal. So fair enough. Just from our perspective, where we were comfortable at wasn't the 70% on this.
I was going to say he has plenty of connections and people that will probably fill that multifamily within months of him renovating it. And we know he does great work because we've seen it on other properties. But came back on Wednesday and needs to close on Friday. We had the file from when we prepared it the first time around. Quick turnaround, but we're able to execute on it.
Yeah, love it.
Yeah. I think it's important for people to always realize, like, as we talk about the creative financing, it's like, how can you go to a bank and say, oh, yeah, I just know people that will rent to this type of asset at this price? Is that a qualification from a bank? No, we can understand where people come from to get these creative deals done.
Well, at the end of the day, he's putting his money where his mouth is, because he's bringing the equity.
Yeah. Right. And it's a combination of both. But Enrique, you got another one?
Yeah, I could talk about one that relates with speed, service, and exit strategy. I had a borrower, a builder. He bought 2 lots in Newport Richie, and right next to each other. He decided to start building 2 identical houses. And he's come to us for different loans, but he loves our product so much that he was able to plan how much he had to be invested in the property, cash basis, before coming to us to request a loan. So we're allowing a seasoned builder to get 2 homes done within 10 to 12 months because of planning. He knows exactly his cost of capital, cost of construction, and he's quite clear of his exit strategies. Once the properties are ready, we're probably going to be at 50% LTV of the ARV. So, I can definitely, this is a really good example for us on how our product is helping other investors build a lifestyle around real estate investing using our capital.
That draw schedule too, he's literally building them simultaneously, right?
Simultaneously, and I could say, they're both at the same stage simultaneously.
Yep.
He suffered a couple delays on the framing side on one of the properties, but he was able to, mitigate it and, I don't know how to say, but level them up in, in inspections.
Yeah, it's tough. We had that going on one of our builds where we had one got held up from a stem wall issue, and now the other one's kind of progressing further and that can happen sometimes. But with our flexibility on the draw schedules, but he bought the lot, had plans, permits, everything ready already, right?
Yeah, he came to us at a foundation stage to request a loan. So to make this a little bit more specific, he actually bought 4 small lots and merged them into 2 bigger lots, and then he started building. So this desirable. Is to make it more desirable. And this has been a long process for our client. He bought these lots over a year ago, so you can see it's been more than a year in permitting, replotting, all those processes.
Yeah. And I remember talking to you about it, and one of his biggest concerns was wanting to do focus, like you said before, on both at the same time, because he did have qualifications to get bank financing, which was initially cheaper than ours, but not as flexible. But in the end, the inability to build both at the same time with the other lenders outpriced the fact that the benefits of dealing with us to do them both at the same time. He had cheaper cost to build. They saved the money. So he was like, I'd rather pay a little bit more with you guys to do them simultaneous. So I remember that was a huge benefit for him.
and speed. Because with the other lender, he was probably going to be able to do 1 at a time and in a span of 8 months. With us, he's been able to do 2 in 12 months or 10 months.
Saves you almost a year.
Almost a year.
That's convenience great. Of the draws too. I feel like that's been a huge thing, right? Is people know that with us, they can get their draws relatively quick. Because with other lenders, not all of them, but we've seen feedback where, it's taken a week and slowing down my project.
Yeah. Those subs need to be paid timely, right? Especially when you want preferred pricing. If you're a builder. So I guess the last one for me then would be we closed the 5 mobile homes on, I think it was 3 parcels. 5 mobile homes, 3 parcels. I know we had it was foreign nationals. They were doing a partner buyout. They were trying to sell it to pay out the investors, but instead they refinanced because 2 of them wanted to keep it, 2 of them wanted to sell.
Yeah.
But 5 mobile homes, I think 2 of the mobile homes were added after they purchased. So we had to go through getting VIN numbers and retiring mobile homes to the land.
Yep.
It's on a couple acres as well. So certainly a unique asset from that perspective, but the cash flow was really strong. So, you know, we after running the cap rate formula, we were in a really good position and allowed them to get the cash they needed to buy out their partners but not over leverage the asset at the same time and maintain really healthy cash flow.
Yeah.
So 5 mobile homes, 3 parcels was a cool one, and it's a really strong asset.
Yeah, and the insurance was difficult too.
Oh yeah, that's a good point. The
Yeah.
insurance was challenging. I know Marta was banging her head against the wall, but she got it done as she always does.
Yeah. Yeah. Flip over every stone until you get what you need. But
Yep.
yeah, she
'Cause
did.
I think really, I mean, for us, like we're really requiring wind insurance on those. I think that was a flood zone too.
Yep.
You had flood zone, mobile homes, wind insurance coverage, needing to get to the coverage to a certain amount too. So that was certainly challenging, but something that Marta was able to get through.
Yeah. No, for sure.
So
I think Marta loves our mobile home deals.
how long? I think you had one for like 85 grand. How long did it take to get insurance on that one?
Yeah, I think like 2 months, 2.5 months. We
Yeah.
were searching for
Underwrote and funded the deal in like 3 days or less
Yeah.
even, and then almost like you said, a couple weeks to get the
The
insurance in place.
I think we've got a
Yeah.
little taste of why some other lenders don't work with mobile homes.
Yeah.
Sub $100,000.
Yes.
But
Yeah.
Austin loves them. Keep throwing them this way. He loves them.
Everybody can see on my Instagram, I do close some of those smaller loans.
All right, cool. That's great. Any final parting words, or I think there's some cool, keep it short and sweet, a couple deal stories and market updates.
No, just don't be afraid to send us the deals. Keep sending them our way.
I love it.
You know.
All right, very
That's
good. Thanks for joining us, everybody, today. Thanks for joining us for another episode of How to Make Money with Hard Money. Like, subscribe, and follow on all social media platforms, and you can catch this episode on Apple TV, Apple Podcasts, and YouTube.